Hi, I want to introduce you now to the topic of accounting for income taxes. And to understand this topic, you first need to understand why accounting for income taxes is problematic. The problem of accounting for income taxes arises from the fact that accounting income is determined in accordance with accounting rules. Taxable income is determined in accordance with the tax rules or legislation, and they're different. They're inconsistent, and so that gives rise to the question of, well, when do you recognise the tax expense? There are basically two choices. The first choice is that we recognise the tax expense when it's actually paid or payable, and we'll call that the tax payable method. Or alternatively, do we recognise the tax expense when the underlying accounting revenue or expense item is recognised? In other words, we match it up. And we call that tax effect accounting. To demonstrate what the accounting actually looks like, it's probably best to think about a very simple practical example. And we have a firm which recognises $100 worth of revenue in 2015. That revenue is not recognised until 2016 for tax purposes, different rules on revenue recognition. So the question then becomes, when do we recognise the tax expense associated with that revenue? $100 at 30 cents, $30. Do we recognise the tax expense when the tax becomes payable, which is 2016? Or do we recognise the tax expense when we recognise the revenue for accounting purposes? And we can see this with the journal entries. If we have the tax payable method, we'd simply recognise the tax expense in 2016 when the tax is paid or payable. Whereas with tax effect accounting, we'd make an accrual for the tax expense in 2015, and we recognise a deferred tax liability, which would of course pay in 2016. Now, if you think about it that way, the issue of accounting for income taxes doesn't seem too problematic, and we can see how it might be straightforward if we think about a simple firm with a single asset, and I think this demonstrates the way in which deferred tax works quite well, or tax effect accounting works quite well. In this example here, we have a firm which purchased a car for $10,000. It's depreciable at 20% per annum for accounting purposes and 33.33% per annum for tax purposes. And you can see how that gives different depreciation expenses, different accumulated depreciation, and different accounting and tax book values. A good way of thinking about these accounting and tax book values is the accumulated depreciation gives us the expenses that have been recognised to date, and the accounting and tax book values gives us the expenses which are to be recognised in the future. So what we can see happening here is that from accounting purposes, after 1 year we've recognised $2,000 worth of expense and there's $8,000 to go, whereas for tax we've recognised $333 worth of expense after 1 year and there's $6,667 to be claimed in the future. So you can see that our accounting and our tax expenses are different, and that gives rise to differences in the future. Quite obviously what we can see here is that if we recognise more tax expense recognise more tax expense early, we recognise less later on, and that's the whole issue of tax effect accounting. We can see how this plays out if we think about the calculation of the tax payable. And you can see that on the bottom of the slide. We can see that the tax calculations have revenue and expenses each year, $10,000 and $6,000 respectively. We have depreciation for tax purposes of $3,333 for the first 3 years, which gives us taxable income. And the tax payable on that is $200 a year for the first 3 years, $1,200 for the last 2 years, $3,000 in total. So what you can see happening here is that because we have much higher depreciation deductions for tax purposes in the initial years, we pay less tax in the initial years, and we pay more tax in the later years. And so that sort of tells us that there's a challenge. Let's just think about how that plays out over time, over the life of this asset. So under the tax payable method, it's pretty straightforward. We'd recognise our income before tax, $2,000 every year. We've got a tax expense of $200 a year for the first 3 years, $1,200 for the last 2 years. Total tax over the life of the asset at $3,000. And we've got quite variable accounting income after tax. $1,800 for the first 3 years, $800 for the last 2 years. And we can see that our profit margin changes quite significantly. What tax effect accounting does is it tries to match up, adjust the tax expense to reflect when we recognize the revenue or expense items for accounting purposes. If we think about the tax effect accounting, we can see that we have the same income before tax, $2,000 a year. We have the same tax payable, $200 for the first 3 years, $1,200 for the last 3 years. But what you can see is we have an additional line which is called deferred tax. That's plus $400 for the first 3 years, minus $600 for the last 2 years. What this is saying is that the depreciation that we're claiming for tax purposes is higher in the first year, and it's higher by $1,333. And because we're claiming more tax deductions, tax expense this period, we're going to claim less in the future. So we need to recognize the tax consequences of that. So 1,333 times the 30 cents in the dollar tax rate, this is $400. So what we're saying here is that in the first year, we're getting an extra $1,333 worth of tax deductions. So we're paying $400 less tax than we would otherwise pay. So we need to recognize that as a deferred tax liability in the first year, in the second year, and the third year. Whereas in the fourth and the fifth year, we have no more tax expenses, no more tax depreciation, and so we end up paying more tax in those years. But that's sort of offset by the fact that we've paid less in the earlier years, and you can see how we've smoothed it out. And we see the reversal of the deferred tax liability in years 4 and 5. So please note that that deferred tax line, it sums to 0. The deferred taxes are ultimately payable. And you can see that the tax effect accounting doesn't change the amount of tax that you pay, just the period in which you recognize it. So the tax expense doesn't change in aggregate, just the period in which you recognize it. Now, if we think about it like that, then you're going to say, how can accounting for income tax be that difficult? Well, where it becomes very not simple is when you expand the issue to one of multiple assets over extra long periods of time. So let's just demonstrate what this sort of looks like. If we have a car which we purchased $10,000 and I'm going to have no inflation, I'm going to have accounting depreciation of 20% per annum, tax depreciation of 33% per annum, and you can see that that gives accounting book values and tax book values, and that gives you a difference between the two, 1,333, 2,667, 4,000, 2,000 and 0. What I'm highlighting here is the fact that if you've got an accounting book value and a tax book value and they're different, that's the 1,333, that means that you've claimed more tax depreciation initially, so you've paid less tax than you would otherwise have to. Tax on $1,333, that's $400. And so what you can see happening there is that we're creating a deferred tax liability. After 2 years, it's up to $800. 3 years, it's $1,200. Then in year 4 and 5, it goes down to 0. So what you can see there in the last column is the change in the deferred tax liability. And that would occur for every asset. Now, let's just think about a simple scenario where we buy one car every year. And what you can see is that whilst if you look across the rows, then for each individual car, you can see that the differences reverse perfectly. But as long as we keep purchasing cars, and we buy another car in year 2, and another car in year 3, and another car in year 4, if you look at the accumulative effect of those differences, you can see that they rise. And we sort of end up with a perpetual motion machine whereby the new differences going in equal the differences going out. And as long as we have what is called a steady state firm, then there are taxes that we're actually putting off forever. And that's a problem. That's a challenge. Because how do you have liabilities that you don't actually end up paying? Let's also think about that. That was done as a spreadsheet. So you could set up a spreadsheet like this And you could think about what happens to these differences, which I've graphed here, these temporary differences, and you can see how they grow. They plateau when the firm goes steady state, and if the firm stops investing, you can see how they reverse down to zero. But what happens if you have inflation? Then the new temporary differences are greater than the older reversing ones, and so that instead of being a flat line across the top at 3,000, it slopes upwards. If you have growth, and instead of buying 1 car a year, you buy 2 cars a year, then you get a step up from 3,000 up to 6,000. So if you have growth and inflation, those temporary differences can get just bigger and bigger and bigger. And that really is the problem of accounting for income taxes. It doesn't behave the way normal liabilities assets do. Another issue is that it's, generally speaking, not well understood. For example, we might look at the income statement here for Qantas, and it shows a tax expense of $328 million. But when we look at the cash flow from operations, we see taxes paid, foreign, only $4 million. What's the difference? Well, a lot of people don't know the difference, but there is an important difference, and you can see that captured in the balance sheet. And you can see that Qantas has had the reversal of the last of their tax losses carried forward. And you can see the deferred tax assets go down from 39 million to 0. And you can see the emergence of deferred tax liabilities. That's not tax avoidance. That's just you're going to be paying the tax in another year, not this year. So you're not avoiding tax, you're still paying it. It's just the timing is mismatched. And a lot of people actually don't understand how accounting for income tax works, and that also makes accounting for income tax problematic. You can gain some insights into this from the notes associated with the determination of income tax, and you can see that shown up above. And in the bottom you see a reconciliation of income tax expense to income tax on profit at the statutory rate. And what we can see here for Qantas in the bottom is there's actually very little difference. So to say that Qantas is avoiding tax, it's just not true. How does income taxes fit within the framework? It meets the definition of liability, arguably, because there's an obligation that's going to have to be paid. Or alternatively, there's going to be a tax shelter, which is created. The real issues are going to revolve around recognition and measurement. That's not such an issue, is it? So where do we go from here? Well, accounting for income taxes is addressed in IAS 12, AASB 112, and we're going to break it down into 2 parts. We're going to think about how the regulation applies generally and the general definitions before we get into the mechanics of calculating current and deferred taxes.